Welcome back to the Teaching Tax Flow podcast, everybody. Today, episode 114, we're going to look at student loans and taxes. So what that means for you, if you do have a student loan, if you have a youngster thinking about taking one, we're going to dive into it here as a team, discuss with you some of the, we call pros and cons of those, but again, how it relates to taxes. And before we do that, though, let's take a brief moment, as always, and thank our episode sponsor.
Are you leaving money on the table? Are you an accredited investor seeking new and exciting investment opportunities? Look no further than Integrated Investment Group, your trusted partner in financial success. At IIG, the focus is on delivering exclusive investment options tailored to your unique needs and goals. Contact them today and let their expert team guide you toward your financial aspirations. Wondering if you qualify as an accredited investor? Visit teachingtaxflow.com/IIG to find out and take the first step towards a brighter financial future. Integrated Investment Group, your path to financial success begins here. Securities offered through Cabin Securities. Member FINRA SIPC.
All right, everybody, welcome back to the podcast. As you heard in the intro, we're going to talk about student loans and how it relates to taxes, something that may not really click with many right out of the gate, right? You think about it, oh, well, I have a loan, a student loan. Maybe it's going to get forgiven. Maybe not. Does that have to do anything with taxes? Well, we're here. We're going to talk about this here in just a moment. And welcome back to the show as always. Chris Picciurro, how's it going, my man?
It's going well. Thanks for asking. And yeah, but this has been a topic that, that gets asked. As you may or may not know, I have the honor of being one of the tax season update instructors for the National Association of Tax Professionals. One of the rule changes was the forgiveness of student loan debt and the taxability of that. So we're going to talk about that in the second part of the show, but we're going to start the show off by talking about the student loan interest deduction. The student loan interest deduction is what we call in the business an above the line deduction. And that means that it gets deducted before we calculate your adjusted gross income. And it allows taxpayers to take a deduction for a portion or all or a portion of the student loan interest that they're paying. Now, remember, one of the laws of teaching tax flow is that your tax agencies are your involuntary business partner. Tax laws are to encourage and discourage certain behavior. These could be financial, social. So what are we saying here is that in general, the federal government is pretty generous with giving student loans out to taxpayers. They are somewhat generous about allowing you to deduct said student loan interest. This is one of those things that I usually don't get into my personal opinions too much about things here. I usually try to be a scoreboard. I personally feel that it could be a much, much more generous deduction. And it falls into that all hat, no cattle category for me. And what that means is that the vast majority of people that are paying student loan interest are either getting phased out of the deduction or not being able to deduct a good portion of it. And quite frankly, many of the people, if you look at the statistics, many of the people that have student loan interest and have graduated from a higher institute of learning, like university or college, typically, in general, will have a decent amount of income and get phased out of even taking this deduction. But let's talk about it because it could be helpful. And it is a deduction that I've seen get missed. People just don't realize it. So what is a deduction? Well, the IRS allows taxpayers to deduct up to $2,500 of interest paid on any qualifying student loan annually. And again, that's an adjustment to your income. So this deduction is better than what we call an itemized deduction. You can take the standard deduction and still qualify for the student loan interest deduction.
That's good to know.
Yeah.
And basically what you were saying there is you said a lot of people just kind of tend to miss this, or when you say miss it, they sometimes forget that they can even deduct this. Is that what you meant by that?
Absolutely. Yeah. They could forget they even have that opportunity. So What qualifies? Well, you have to have a qualified, or how do you get the deduction? You have to have a qualified loan. So the loan had to be taken out for the purposes of higher education. John, when you took that loan out and went and bought a Camaro, that doesn't qualify. Sorry.
Oh, bummer. Oh man. I was
I
trying to
know.
think of some smart remark, but you did pick a pretty good car to use there as a faux example. At least you didn't say,
Well, and
go
I figured,
buy a Honda Civic or something.
it had to be a GM car, John.
There
Had
you
to
go.
be,
You know
we know
well.
the-
You know me well.
Yes.
So-
You have to be an eligible borrower. Good grief, that came out like a
You're in the holiday spirit, my man. It's all good.
that came
You
out
must
like a
be
fart in
frozen.
church, huh?
Yeah.
So
That was a good
you have to be eligible. If you don't qualify, if the borrower.
Come on, buddy. You got it. You got it. You got to get it
Golly.
out there. We're gonna have, you know what? We're gonna have to send you back to college, but we're gonna send
I'm
you
gonna
back to an
have,
English course.
We're gonna have a speech therapist over the house, later this afternoon. It has to be for educational use, like we said. And married taxpayers filing separately cannot take the deduction. Now that seems like, man, that the IRS is really being a meanie, aren't they? There's a reason. The reason is that there are phase outs due to income. And so you can't take the deduction if you're filing married separately. And like I said, there are income thresholds. We're going to talk about that next because I feel like they should be more generous. So I think the IRS is being a meanie when it comes to these thresholds. It's actually not the IRS. It's the federal government. The IRS is just the
Grinch.
police force. Yeah,
Well-
they don't make the laws.
Right. And I know this topic just as a whole here, as we talk about, the relationship of student loans and taxes, there's not a whole lot of, we won't say there's not a whole lot of meat on this, but this really isn't a 30 or a 45-minute discussion on this because a lot of it's pretty straightforward for the most part, right? Like it's not like we can go off into a lot of theories and concepts and all this stuff. There's a limited amount of information out there on this, should we say.
Correct. So when does this phase out occur? I'm going to talk about the 2023 tax year. I know we're in 2024, but we just finished filing season for 23 with extensions. The phase out starts for single taxpayers at $75,000 of adjusted gross income, $155,000 for married filing joint. The deduction is completely phased out if your adjusted gross income for a single person exceeds $90,000 and $185,000 for married joint. So if you are a single taxpayer and make $90,000 or more of adjusted gross income, you're on Santa's bad list when it comes to student loan interest deduction, and you get nothing. If you're between 75 and 90, you get a portion. And if you're under 75, you get up to $2,500 per year of student loan interest. And again, say for the married jointly, it's $155,000 and $185,000. I think again, I think those threshold phase outs, and I'm not the only one, are not very generous. Now, I'd be remiss if I didn't mention this. This is a different topic when we talk about filing status, and when there are some unique situations where you would be better off filing married joint or married separate than married jointly. One of the reasons that you would file married separately has to do with student loan debt. It doesn't have to do with a student loan interest deduction, but many student loan debt repayment schedules are based on your income. So if you are filing jointly, that takes into account your spouse's income instead of just your income. So there are times where you might want to file married jointly to make sure that your debt repayment or your student loan repayment, monthly payment, is either exempt or zero or very, very low. And that kind of plays a role in our second thing we're going to talk about. But I would be remiss if I didn't mention that part of it.
Makes total sense. And yes, as we kind of go through this, right? Like it is interesting. And back to what you said before, is like people sometimes even forget about it. Maybe it's, say they got out of school, they had a good opportunity, they made a bunch of money, and maybe there was a career shift. Maybe now they're below that threshold, right? So and I imagine that kind of resets itself, obviously based year over year, not the year that you started any repayment program. as far as for taking that as a deduction. So
Actually, that's a great point, John. There is no look back period. There are some things that have a look back. For instance, when we talked about the clean vehicle credit for individuals, there's a look back period where there's an income threshold, and you can either factor in your previous year's tax or the tax year of the purchase of the vehicle. For this, there's no look back period. And that's what I'm saying is a lot of people that have student loan debt interest are actually are making money in excess of the threshold. So ultimately the whole student loan interest is now a personal expense. Now, I talked about sometimes your filing status could affect how much your payback is. Ultimately, you're going to have to pay your student loan interest back or your student loan debt anyway in general, but there are some relatively new rules under the American Rescue Plan Act of 2021 that allows for forgiven student loan debt to be tax-free. So if you think you're going down the path where your student loan debt's going to be forgiven, you want to lower the amount of repayment, right? Who wants to, and that comes down to tax planning and filing status. In general, any forgiveness of debt is considered taxable income. So that's your default. However, this American Rescue Plan Act of 2021 put a temporary exclusion for student loan debt forgiveness between the years of 2021 and 2025. So in this situation, loans forgiven under most federal or private forgiveness programs are not included in taxable income. And this provision applies to both federal student loans and private educational loans, assuming that the forgiveness meets the program requirements. So we're going to talk about what those requirements are. But if you have a student loan debt that got forgiven between 21 and coming up here into 2025, you might be scot-free. You might say, look, not only do I not have to pay the student loan back, I don't have to pay tax on that debt forgiveness or cancellation of debt, it's called.
So that's like two high fives.
It's a double high five. It's almost a cartwheel.
Right. Yeah. Perfect.
If you look, you don't want to see either one of us try to do a cartwheel.
No, it would be a bad situation.
It would be very bad, and it'd probably be an injury. We'd probably be in physical therapy. So not only would I have a speech therapist coming over here, I'd also have someone coming over to help me move around.
Right. Oh boy.
So under the American Rescue Plan Act, there are some permanent exclusions for certain programs as well. So that temporary exclusion is from 21 to 25 for student loan debt forgiveness being taxable. Okay. But the American Rescue Plan said, you know what? We need some people in certain industries. Remember, tax laws are written to encourage and discourage certain behavior. So we need some people in some industries, and we're gonna say, you know what? We're gonna make that student loan debt forgiven and tax-free if you meet one of these exclusions. And those exclusions are going to be public service loan forgiveness. So public service loan forgiveness is not taxable if the loan is forgiven, but they require the borrowers to make 120 qualifying payments while employed full-time in an eligible public service job like government or nonprofit role. So that's why you might want to file. Let's say you got married, you might want to file separately to keep those payments really low. Ultimately, let's say you work in a government service job or you work at a nonprofit. Okay, if you have a student loan debt and you make your payments for 10 years, whatever you owe after that 10 years could be basically forgiven and tax-free under this public service loan forgiveness program. So that's pretty generous, especially because we do need more people in public service jobs, in government, and in nonprofit roles.
Right. And for that one, I guess kind of an odd question maybe is, so even though, I see it actually now looking back at our note a little bit where you had mentioned it was previous exclusions, or I'm sorry, permanent exclusions. So this doesn't fall into that between 21 and 25. So this is something that moving forward, I see. I actually wrote that down here.
Yeah, yes. And I was unclear a little bit. So that under American Rescue Plan gave us that temporary exclusion for student loan debt forgiveness, but these are permanent. So really nice for the public service loan forgiveness. There's teacher loan forgiveness. So teachers in low-income schools that meet certain criteria can qualify for forgiveness up to $17,500. Again, let's say they have a student loan for $35,000 and it gets completely forgiven. A teacher in a low-income school that meets the criteria. $17,500 of that would be tax-free. The other amount would be taxable. But hey, I'd rather pay the tax on $17,500 than pay it all back, right? And you might be in a lower marginal tax rate. If student loan balances forgiven due to borrower's death or permanent disability are now excluded from taxable income as well. So that's that, and that makes sense, right? I mean, what happens if you, God forbid, you have a student loan debt, and you start working, and something happens where you're permanently disabled. You can't work anymore. You really can't earn income to pay the student loan back. That would be forgiven and tax-free. So those are things to think about when you're talking to doing tax planning, even financial planning to an extent for younger, let's say not just younger, but taxpayers that are just getting out of school, getting into the workforce, their student loan debt could be more than a mortgage, right? Especially what if they went to law school or medical school? So there's a lot of planning has to be involved when it comes to that. And I have one more little fun thing to sprinkle into this conversation before we.
What you got? What you think?
So so now we're going to shift gears. It's related to student loans, but not necessarily the student loan interest deduction. But I feel that we'd be remiss without mentioning that. So what do we know? We know that a lot of younger people are not contributing enough to their retirement plan. We know that the Secure 2.0 Act was enacted to allow more money to be contributed to retirement plans because, one, the Social Security fund, there's concerns about that. And just in general, people aren't funding their own retirement plan as much. So one of the things the Secure 2.0 Act did, 2.0, there was a Secure Act of 2019. The Secure 2.0 Act came in 2022. But employers now can contribute to student loan payments. So instead of the employer funding a retirement plan contribution, employers can make retirement plan contributions on behalf of employees who are repaying student loans. So it could help. So the employer can, instead of contributing to a retirement plan, put the employer contribution into paying off a student loan.
Interesting.
Yeah, and it can, I've yet to see this actually happen, but again, it's out there, and that started here in 2024.
And honestly, I haven't even heard of that either. So that's some news right there. Interesting.
Right, and it ultimately it helps. It helps with employee retention. It helps take the burden, because again, that student loan repayment, monthly repayment amount could be really a significant amount of someone's, discretionary income. So if you have a new team member and the employer says, "Hey, I want to put money in your retirement plan," the employee might say, "You know what? It'd be really much more helpful for you to pay some of my student loan payments."
Yeah. And I'm sure, like you mentioned, I'm sure some people really, that's very beneficial to them on both sides of the fence.
Exactly. So if you're an employer, or you think this might be helpful, just reach out to your tax professional or jump into the Defeating Taxes private Facebook group, and we'll help guide you in the right direction.
Awesome. Well, everybody, I know we're kind of inching towards the end of the year, obviously right in between this little sweet spot of the holidays. So just wanted to get this one out there as well as, and I was just looking at this too, Chris, as you were chatting a little bit just on our topic schedule for 25. So I know we got some good stuff on there, and we're always looking for ideas. So if you guys have some topic suggestions, as we mentioned, a little bit more than most on the last episode that we did, shoot them over to us. We'd love to hear them. Worst case scenario, they might not happen next week, but we could change up our schedule a little bit and we could adjust. And, as things come up, we usually like to address them as quick as possible while they're relevant. So that way, you don't have to necessarily search through Google for information. You could just subscribe to the podcast. Little humble brag there. We tend to be a little bit more credible than a Google search. So just saying what's true. But definitely check us out if you haven't yet. Again, subscribe to the podcast. Check us out. Subscribe to our YouTube channel and Defeating Taxes. So defeatingtaxes.com. That will actually take you direct to that private Facebook group you are invited to. So you can't say we didn't send you a present. Sure, we didn't wrap it up. We didn't deliver it to you under your tree. But that's your invite. Defeatingtaxes.com will get you in that group. So as always, this one was a little bit shorter, though, than most, but we'll see you back here again on the Teaching Tax Flow podcast next week, different time, and per our schedule, completely different topic. So have a great rest of the year, everybody, but we'll see you here next week. Have a good one.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.